Thanks for joining us on this episode of BayBridge Real Estate Capital Talks. In this series, we interview successful real estate insiders to get their perspectives on different sectors of the industry, all with a financial focus. Our firm helps bring institutional capital to the real estate markets across the United States. Sector expertise is important to our success and yours. Today, we're talking to Evan Weiss, COO and founder of LWHA Hospitality Advisors.
I think the big thing that folks have to consider also when looking at any hotel, whether it's urban or suburban or resort or massive group convention, is the food and beverage side. Do we allow people, does 1,000 capacity ballroom by fire code now become 500 by COVID code? Right? Do we now have a rooftop that used to generate 15, 20 million in New York, Chicago, LA? Does that rooftop now have 35 to 50% capacity? And because of staffing levels and bartenders and whatnot, now you have, the revenue capacity, it doesn't just go in half, it actually goes even lower. So now you have 50 million, now you have 6 or 7 million. And by the way, that 6 or 7 million is less profitable. Right. So these are, and by the way, these are questions. These are thoughts. These are not proclamations or even opinions. There's just a massive amount of consideration. So again, I think limited service, easier to turn, a lot of and extended stay do fare well as return sooner. I think there's some markets where they could return to EBITDA levels in 12 to 18 months even. From the beginning. It's possible. I don't know. It's case by case. It's asset by asset, asset class by asset class, market by market. And then obviously the big full service and the big resort locations that are group oriented. Again, like the Phoenixes, maybe San Diego's, Orlando's of the world are in for some pain for the foreseeable future. Now it's all about demand. Where's your demand? Is your demand you look at New York City. I mean, your demand's significantly international. When do travelers from Europe return to New York City? So urban can be challenged for some time. At the same time, we're also seeing now that certain states, particularly like North Carolina, Georgia, Florida, they're starting to reopen. Miami hotels, I believe, are able to reopen on June 1st. We'll see a lot of that happening, and we're seeing sort of this revenge travel, if you will, or the people are just, once they're allowed to, they're out. They're going to get on planes, and they're definitely going to get into cars, and they're going to go to resorts. And by the way, this is nationwide.
Next question, I think, is the $100 billion question. And
yes,
there's wild assumptions, right? It's valuation. We've heard everything from hotels trade, 20, 30 cents on the dollar to 85, 90 cents on the dollar. You as one of the, call it, trusted opinions on valuation in the hospitality market, what is your outlook on valuation?
That is the 100 billion, maybe the $1 trillion question. We have colleagues out in the field that are projecting that values are down 30%. Other folks are saying value returns in 3 years, 5 years, 2.5 years. What I would say is that if you had to paint an enormously broad brush, I would say on the upside, again, for given assets, most buyers are looking for a 30% discount and sellers are looking for a 20% discount, right? And some of those deals are probably going to get done around 25. The answer really is that you really have to underwrite the asset. There are so many different things. So again, I by the way, I believe that there are some select service hotels that could trade 10, 15% off of pre-COVID valuations. And I believe that there are some full service assets that could, that are group oriented, that if they had to trade, if there was liquidity need or end of a fund or something of that nature, could trade over 40% below. I think that the delta is that wide, really between 5 and almost 50. But 20 to 30 seems to be where people are talking about. And a lot of the deals that were either on the books pre-COVID that sort of, got put on the shelf, they are looking that they're coming back. And this is mostly anecdotal, somewhere in that 20 to 30% range. I spoke to one capital markets firm the other day, and they were telling us that they're looking at something around 25% for a particular asset in a major urban market. It's really, really hard to say where valuation is. Again, it's asset class specific, it's location specific, it's demand specific. There's such a lack of transparency as to exactly when when activity will return, when RevPAR will return, when EBITDA will return. And so if you're a buyer, you have to potentially bake in anywhere between 2 and even 12 months of losses, something you've never done before. Not even necessarily on a transitional asset, on an existing asset, right? So if you have to bake in 2 to 12 months of losses, and then also if you're buying, you're probably buying cash. There's little to no debt. You can talk more to that, Jay, of course, but there's little to no debt available for most asset classes, particularly for hospitality and probably retail as well. I'll stick with what I know, hospitality. And we've been hearing that anytime there is an offer for debt, it's usually closer to 45, 50% LTV versus, let's say, a 65% LTV prior. So you're talking about a 10 to 20% reduction in loan to value. The V is lower, the value itself is lower. So now the proceeds are even that much lower. And then they're looking for, L plus 800 or 900, right? Versus pre-COVID, it could have been like L plus 250 or L plus 300. So you're looking at this massive, and so all that affects valuation at the end of the day. All that affects the discount rate. We like to look at valuations on a 7 to 10 year discounted cash flow analysis basis. Again, we on the valuation side, we reflect the market. We don't look to make the market. And anyone doing a valuation today, you can't use a cap rate. It's even hard to use a room. It's even hard to use a room or gross revenue multiplier. The best thing to do is to use truly, especially if the asset is worth more than $5-7 million, use a 7 to 10 year discounted cash flow analysis.
One thing that we see is, everyone's trying to figure out, how to lend money with the valuation, what basis can they put that loan at, what to buy at. All of our clients that own hotels, well, what is this worth? Where do I stand? How levered am I, right? The one thing that we can tell everybody, and you probably see the same, is that there's just tremendous amounts of dry powder waiting to buy distressed hospitality assets. And from my assumption, from everybody we talk to is 2 billion, 5 billion, waiting to buy these deals. And it just seems like there's a little bit more money than there's more buyers than sellers. And so that should stabilize the market fairly quickly once we kind of see some of these trades happening.
But I do believe that you're spot on in that there used to be, by the way, if you and I compared notes, we'd probably have a list of 10 to 15 $500 million to $2 billion players, folks with verifiable cash, real players that are interested in buying hotel debt, hotel assets, or both, or lending billions and billions of dollars. And so when there is that, sort of turn, when the assets do start hitting the market, when the debt does start hitting the market, there is the possibility that these assets, and especially the better assets, get bid up, and that it sort of becomes about on a per pound basis versus an economic analysis basis, right? We're talking about, those large scale, convention resort properties, 1,000 plus rooms and multi-100,000 square feet of meeting space. By the numbers, economically speaking, yes, some of them probably should have a 30 to 40% discount if they were purchased today, but they may be looked upon as marquee, once in a generation type assets. To build them will cost $1 million. Let's say that 40% discount is, I'm throwing out numbers, is $500,000. So someone said, you know what, cost $1 million a key to build this, I'll buy it for $650. I like that basis. I completely agree with that point. There's a ton of capital out there right now, which I think is ultimately going to be good for the space. It doesn't bode well for kind of anyone for there to be massive discounts, and they'll probably even out the discounts. Still discounts, but not nearly as steep.
Pre-COVID, we obviously had Airbnb and lots of spin-off versions of kind of this, right?
Yep.
You saw Stay Alfred already kind of run into some issues. You have Sonder. How do you think that short-term kind of tech view rental model is going to be affected from COVID, whether positively, negatively, or?
I think we'll definitely see a little bit more bloodletting. I think the Stay Alfred was the first of a few. There are probably smaller players that have either gone out of the market or are probably trying to market themselves right now. Just from a liquidity perspective, they really don't have access to the capital markets like the hotel companies and the REITs do. So a lot of them will probably go away or get sort of assumed by the larger players. Sonder, Domio, they're larger. Airbnb, obviously, there's been plenty of ink spilled on that, whether they've raised $3-4 billion at 10, 11, 12% interest rates, whatever it is, but they'll survive this. Maybe in a weaker position, I've seen valuations as low as even, $10, $11 billion, whereas, pre-COVID and before all this, they were probably worth somewhere, they were worth, they were being valued, I should say, at closer to 30, $40 billion. I think that one of the things that we didn't talk about is brands, right? You're going to want to stay at a branded hotel, Marriott, Hilton, Hyatt, IHG, whatever it may be, because you know what? You'll get an email with what their certified cleaning process is. You'll feel good about it. You'll walk in the room. There'll be a smell to the clean, right? The door will be, maybe they have some sort of like tape on it, like, some bathrooms have, at certain hotels, like this has been cleaned, by so-and-so at this time and checked by this person. So you'll have that level of security, if you will, security in hygiene. So on the Airbnb side, I think it's going to be really challenging. I think that single family homes are doing rather well right now because people are looking to get out of the urban market. So those are doing well, right? VRBO, Airbnb, home away, they seem to be doing well in the single family homes. A lot of the models for like the Sanders and the Domios were to take over full buildings or full floors or whatever it may be. That was sort of where their business model was shifting, whether it was on a lease basis or a management basis or whatever it was. I think that that's going to be challenged. I think that travelers are going to want that security of a hotel stay. So their growth may be halted for some time. Long term, I think it's still a good business model for them. I do believe as a hotelier that there should be an even playing field, whether it's occupancy taxes, sales taxes, life safety, all that, and that's fine. But it's innovation, it's technology. Airbnb survives. I think they come out of this. I don't think stronger, but I think that, and I think a lot of these units actually come off the market. I don't know about you, but I have no desire to go to a market and go stay in someone else's house right now. And frankly, I have no desire to rent out my own home to someone else and say that they have COVID, what's their cleaning process? Do I feel comfortable going back into my own house? And certainly do I feel comfortable going into theirs? I think that again, there's a consolidation in that industry from, let's say, whatever it is, 15, 20 players, maybe to 5 to 10. And listen, there's always the opportunity that a brand buys one of these guys. I mean, if you think about it, the Sanders, the Domios, the Stay Alfreds before they went defunct, what was their business model? Their business model, shifted from a lease business to basically a managed branding business, right? They were a managed branding business. That sounds very familiar. Yes, it's called the hotel business here in the United States. And so ultimately, they're just a different type of brand. And it's possible either they buy a small brand or they get assumed by a brand. So that's also a possibility as cash flow and reliability and safety concern and health and safety concerns become greater.
Absolutely. Well, thank you, Evan, for joining us today. To our viewers, I hope you found this episode interesting and insightful. If we can help you access capital for your projects, please reach out to us through the information on your screen. See you next time.